Hey guys, welcome back to another video on my channel. If you are returning, then thank you so much. You are the real OG. And if you are new to my channel, then you are welcome here and thanks for joining. So I've realized that on my channel, I talk a lot about investing, but I don't really speak about why you should invest and what the power is behind investing. So today I'm going to be talking about the power of investing, and I will also talk you through some easy steps that you can take in order to start your own investment journey. Of course, I'm going to preface this with the fact that this is not investment advice. Please do your own research before you do your investments or seek the relevant and appropriate financial advice, but I'm just sharing with you the things that I have done that have worked for me. Also, it's important to remember when it comes to investing that your capital is at risk. So anything that you put into investing can potentially be lost. And of course, if you enjoy the video, please don't forget to like and also subscribe if you're watching my videos. It's a really nice way for me to know that people are enjoying the content and I should continue what I'm doing, but it also helps the YouTube algorithm to get this video out to other people who may also benefit from the information that I'm sharing. So I'm going to start by busting a myth that investing is only for richer people or for the elite, and that is not the case. More so now than ever before, investing is for everyone and is even accessible to everyone. I am someone who also believed this lie for a long time. I believed that the entry requirements or the minimum deposits that would be needed to invest would be something that I couldn't afford, but that's because I didn't do my own research and I didn't actually know that you don't need a lot of money to start investing. So I'm going to start by going through some really important reasons why it's important to invest. Then I'll take you through some easy steps that you can take in order to start your own investment journey. And at the end of the video, I will show you the actual power of investing, and we'll look through some numbers and go through it together. So the primary reason to invest is to beat inflation. So savings accounts right now are at an all-time low. They're at less than 1%, and so you are generally getting nothing in order to keep your money into a savings account. However, inflation is still continuing, and generally, on average in the UK, inflation is around 2% on a yearly basis, which means that the prices of food and goods and services increase generally by about 2% on a yearly basis. But if your money is sitting in a savings account and only acquiring 0.5% interest, your money loses its spending power. So over time, as inflation continues, what you could originally buy for £1 is not what you can buy in the future for £1. A really good example of this is the Freddo chocolate bars. I used to love these growing up. I'd get them all the time, and I remembered them being 10p per Freddo bar. Now they are upwards of 50p per bar, and that is a prime example of inflation. What used to be 10p is now 50p or more. So in order to make sure that our money increases with inflation, we can't rely on savings accounts, and this is where investing comes in. Investing gives your money more potential to grow in the long term and grow in line with inflation, if not more than inflation. The second reason is to secure your future. So if you already have a pension with your employer, then you are technically already an investor. But of course, when it comes to your employer-based pension or any pension at all, you cannot access that money until you are 55 at minimum, and this age is generally increasing as time goes on. So it is important to think about our future when it comes to retirement and when we get to those later stages in life where we do not want to work anymore. And I really speak about this in a lot of detail in my pensions video linked above, and I really do recommend that you check out that video if you want to know more about pensions. The third reason is to give yourself options. So thinking about retirement may be something that's way further down the line for you, like it is for me, so that seems a bit out of touch. However, you can give yourself options and freedom way before that retirement age. And a way that you can do this is through investing in a stocks and shares ISA. And the reason why I recommend a stocks and shares ISA is because it is tax efficient and it acts as a wrapper around your money. So any money that you put into a stocks and shares ISA within the annual allowance, which is currently set at £20,000 and doesn't seem to be changing anytime soon based on the most recent budget, your money is able to grow within that ISA and not be taxed. So any growth within the ISA you would not be taxed on. The great thing about these ISAs is that you can access this money whenever you want. So unlike pensions, which have age requirements, with the stocks and shares ISA or a general investment account, you are able to access this money as you need it. So if you were to invest for the next 10 years, for instance, and within 10 years' time, you want more options in your life, you want a bit more time freedom, you may have that option available to you because you could live off of some of your investments. Now, of course, this is dependent on how much you invest and how much growth your investments see, but you are able to set yourself up so that you have those options if you so wish. And the fourth important reason is because it's how the rich get rich and stay rich. So investing, of course, we know this is something that the rich people have done for many, many years. But as I said, it's not just for the rich anymore. And so we need to apply some of these same principles that they are implementing in their life into our lives because we can. So a lot of rich people have people handling their portfolios for them and making investments for them. And this is how their money keeps going and doesn't run out. And that is the beauty in investing. If you take a long-term approach to investing, you can reap long-term benefits. So as you allow your money to grow in an investment account over time, you will start to see some incredible effects of compounding and your money could grow exponentially. Now, I speak in my FIRE videos about how it is possible to live off of your investments. And for anyone who wants to make sure that their investments continue long term and don't ever run out, then the recommendation is to live off 4% of your investment portfolio each year. I speak much more about that in my FIRE series, so feel free to check that out if you're interested. So now let's shift gears a little bit and talk about the steps that you could take in order to start your investment journey. So I'm going to just be sharing the things that I found helpful before starting my investment journey. So step one is to get familiar with the basics. And so this step is really about increasing your financial literacy. So there are lots of books and podcasts and articles that are available out there at any level or stage that you're at to help you understand the basic concepts behind investing. So some terms that I would say would be helpful to grasp in order to gain that financial literacy would include compounding, individual shares, investment funds such as ETFs, index funds or mutual funds, asset classes, risk management, and tax efficiencies such as ISAs. And although these concepts may sound difficult at first, and some of them you may not be too sure what they mean, I promise you they actually aren't rocket science. So if you haven't started your investment journey yet, I do highly recommend that make it a goal for this year, make it a goal for 2021 that you're going to find a book that you can take time to sit down and read and start to understand the concepts behind investing. Step 2 is to do a financial health check. So this is to do a financial review of your own personal finances. So before you start investing, it's good to set the scene and know where you're starting at and what you need to improve or change before you start investing. So if you are someone with debt, for instance, and some of the debt that you have has a high interest rate, then investing probably isn't something that you should consider for right now. And that's mainly because you may not growth that you need to see in your investments in order to counteract what you're paying in interest on your debt. So for instance, if you have a credit card and the interest rate is 19%, then for investing to be worth it, you would need to see more than 19% of growth. And that is not guaranteed to be achieved, so paying off your debt would be your first point of call. Another thing to consider in doing your financial health check is setting up yourself an emergency fund. So this emergency fund is essentially money that you have set aside so that you can access if you have an emergency. And this is really important to have some money that's in a savings account that is easily accessible and not in investments. And the reason why this is so important is because if you put your savings into investments and an emergency comes up and your investments are currently at a loss, then you would have to withdraw your investments at a loss. And so you've actually lost money. And of course, another important component in this financial health check is to have a budget. So without a budget, you don't really know exactly what amount of money you can invest each month, what amount of money you can't invest each month. And so it's really important to know what your numbers are and what you're able to do. And also a thing I would recommend is not to overexert yourself. So don't put yourself in a predicament where you invest maybe £500 per month, but really you can only afford £300. If you do that, then it's not going to be sustainable long term. You're probably going to have to end up selling your investments when you need that extra cash. And really the goal of investing is to do it long term for a minimum of 5 years, but preferably at least 10 years. Step 3 is to set yourself some investing goals. You can keep it simple with this. You can use the why, what, where, when, how approach to setting your investing goals. So let's start with the why. Why are you investing? What would be the goal of your investments? So is it because you want to be in a financially free or independent place in the next 10, 15, 20 years? Is it for a child's future education, that you want to put money towards their university degree or even their first home or future wedding? Is it for a future home that you're looking to buy? What is the why behind your investing? And this is so important because this will help you keep motivated along the journey. And then what? What is it that you're investing in? Are you looking to invest in a specific asset class? And by asset class, I mean, are you looking to invest in stocks and shares? Are you looking to invest in commodities such as gold and silver? Are you looking to invest in real estate properties or buy-to-let properties? It can be a combination of assets, or it can be one particular asset that you want to invest in. And where? Where is it that you're going to invest? So of course, there are lots of investment brokerages out there that you're able to use. You may have a personal preference for one, such as AJ Bell or Fidelity, or you may not know exactly which brokerage that you would like to use. There's lots of resources out there on the internet to help you choose which platform would be best for you. Oh, and of course, do they have what you want available? That's important. There's no point of opening up an investment account with someone who doesn't have the types of things you want to invest in. When is it that you want to invest? How often do you want to invest? And this links back into your budget. So do you want to invest on a monthly basis? And if that is the case, then this approach is considered a dollar cost averaging or pound cost averaging approach, as you are investing whether the market is up or whether the market is down, because you are investing every single month no matter what the markets are telling you, and this generally allows you to ride out the waves of the market. However, you may be someone who's a lump sum investor, so you don't do it every month, you may do it once a year. And lastly, how much? And so how much money will you invest each month? Again, this ties back into your budget. How much can you afford to invest without stretching yourself? And also keeping in mind that your capital is at risk. And also with how much are you desiring to end up with? Do you have a goal? And if you have a goal, how much do you need to invest per month in order to reach that goal? And step 4 is to develop a strategy. And the reason why this is so important is because it helps you to take the emotions out of investing. So as one study has shown, the best investors in the world are dead. They can't use their emotions to take out money when they shouldn't or put money in when they shouldn't. So this step really ties in with the previous step of your investing goals, because once you have your goals in place, you're able to develop that strategy. So you know when you're going to invest, where you're going to invest, how much you're going to invest, what you're going to invest in. And once you've made these decisions, write it down somewhere that's concrete so that you're able to stick to the plan. And once you have a plan, unless there's a valid reason for you to make alterations, stick to the plan. So now let's have a look at what it is that you could potentially get if you were to invest X amount each month. So we'll vary the numbers so that we can see a variation of scenarios. And I'm going to be using a 7% annual interest rate. So this is generally what's considered the average return of the total stock market, and they use the S&P 500 as the benchmark for this. So keep in mind that this is the average return after inflation. Before inflation, it's closer to a 9 to 10% yearly return, but for the purposes of this demonstration, let's do a 7% yearly return. Okay, so we're going to start with a £0 initial deposit. So we're going to assume that you're starting at 0, you don't have any investments to date. And as I said, we're going to assume a 7% yearly interest rate, and we are going to use a 10-year time frame for these scenarios. So the compound will happen monthly, and in terms of deposits, we're going to first start with a £50 deposit each month. So if you were to invest £50 each month for 10 years with a 7% yearly return rate, you would end up with £8,654 at the end of those 10 years. And this is a total of £2,654 that would be earned in interest alone. So if this was in a ISA, for instance, that £2,654 that you earned in interest would be absolutely tax-free. You wouldn't have to pay tax on that. So now let's double that amount to £100 a month and see what you would get at the end of 10 years. At the end of 10 years, it would be a total of £17,308, and the interest earned would be £5,308. Now again, you wouldn't pay tax on this if this was in an ISA. Now let's double that again. So from £100 to £200. And we see that at the end of 10 years, you would potentially have £34,616 and you would have earned £10,616 in interest. Now let's just pause here for a second and think. £200 per month is something that quite a few people probably can, if they tried and they set up their budget in a certain way, they could invest that per month. And at the end of 10 years, you would have £34,000 saved. Now that's a lot of money to have saved, and a lot of people have nowhere near that in their savings accounts. So this right here really goes to show you the power of investing. So although you would have deposited only £24,000 in that 10-year span, you end up with £34,000 because you're earning over £10,000 in interest alone. So now we're going to be cheeky and we're going to double this again from £200 to £400. And now we start to see some quite big numbers. So the final number would be just under £70,000, so £69,233, and the interest earned would be £21,233, which is insane to think you would earn all of that in interest, but it is very possible. Also keep in mind that the yearly deposits are equivalent to £4,800 if you were to invest £400 per month. If you were to do this within an ISA, you are well under the annual allowance. So all of this money, yet again, that £21,000 that you earned in interest would be tax-free. I'm going to do a final amount of £800 per month, which yes, is a lot of money, but let's just see what that would result in. So if you were able to invest £800 per month, you would have a final value of over £138,000, and you would have earned interest over £42,000. So £42,000 worth of interest would have been earned in 10 years. And again, because the yearly deposit is less than £20,000, and in this case is £9,600, you would not pay any taxes on that £42,000 in an ISA. So really, those numbers do speak for themselves, and they really do show the power of investing, especially when you are able to invest maybe £200-300 per month, and you're also able to invest for a longer period of time. So I know this has been a slightly longer video, but I really hope it's been helpful for you to think about investing maybe in a different light, and for you to really see the ability to make your money grow and stretch further in the long term. Thank you so much for watching, and I really look forward to seeing you in the next video really soon.